Yo guys, SuffFX, welcome back to another video. So yeah, I recently took a trade today around 9:30 on crude oil, mainly because the Nasdaqs are looking a bit crazy. I'm not even gonna lie. A lot was going on within this range, but yeah, crude oil was no exception either. But yeah, I'm just simply breaking down the trade taken, which was taken on the 1 minute time frame. Right, pretty decent. Right, let's do this. As you can see, yeah, it was pretty much a minor low-hanging fruit trade. Let me hide this, do it like that, so we can, just focus on that. And now, on Twitter, recently be getting videos or questions asking, how do you trade within Q4, and how do you know that Q4 is simply gonna be a continuation or a reversal? Right, so I'm simply about to show you that, and it's pretty much very, very, very simple. Right. Okay, if I am to remove all these annotations, right? Okay, in case you're wondering how the bias began, right? It was pretty much simple, right? We're like in just simple all-time highs, right? Price was simply above the Q3. Sorry. Or simply just above the Q3 high, right? Let me just remove this Q4 high. In fact, Q4 high, right? So was initially anticipating low prices from that range, right? Yeah, that was pretty much the bias because there's pretty much no other PDRAs or anything to fall back on to use as low prices, right? So in simple terms, on the grand scheme of things, I was pretty much trading against the overall narrative, right? The overall direction, right? But with this model, it's allowed per se, right? So simply our first bias is we serve the higher time frame liquidity range, right? And there's no forms of PDRAs or any forms of inefficiencies above the high. So that is pretty much the only thing that we would fall back on. But now everything within our trading is to align with that, right? So here's how I pretty much trade the micro cycles, right? If you can pay attention, if I'm to do this, right? If I'm to do this and then just scroll lower and enable the New York session 5-minute time frame session cycle, right? Like this. Then we're gonna have it loading. Let's just see. What is it that you see? Price sweeps the London high, right? Okay. Price sweeps the accumulation high and sweeps the Q2 high, right? So there's only two ranges we're focused on. The London high, right? And we're trading everything within Q3. So we're just trading the 90-minute cycle lower, right? The only liquidity range we're looking at is the Q2 range, if that makes sense. And then if I am to remove this, it should look something like this. Okay, let's switch that off. Then let's go to the 1 minute time frame. Within the same range, it should look like this, right? So price sweeps the Q2 New York quarter high, which is buy side. And how I mark out my ranges, right, is not based on clear liquidity ranges like this, right? I use time as my true liquidity, highs and lows. So this, to me, is the true sweep of buy side. This right here, based on time, right? And then when Q1 sweeps the higher time frame quarter range high, right? We need to see price sweep this one. But when it fails to do that within Q2, right? We expect Q3 to do that. And then the distribution can begin within Q3. And then we anticipate Q4 being a continuation. Because the thing is, if price fails to distribute lower, reaching the Q1 low within Q3, right? That's how we anticipate Q4 being a continuation or the initial distribution lower. So in simple terms, Q2 would be disregarded in this range, right? And then Q3 is simply behaving as the true manipulation, right? And the distribution, meaning that as soon as price sweeps the accumulation high within Q3, we can anticipate Q4 to be a continuation lower, right? If Q3 does not reach the low, right? But now here's the thing. Even though price has swept the high within Q3, right, we still allow ourselves to take a trade within Q3, right? Meaning that if you had any forms of entries within this range right here, it's allowed. It's permissible, right? Okay. Then we also expect Q4 to be initially just a simple continuation of that. And your draws on liquidity, especially when you're trading against the overall narrative or the overall high time frame bias, right, is lower quarter sell side, right? I just anticipated price pretty much going to this low right here at least, if it was going to spike through this one. And the reason why I pretty much anticipated that, right, is that when I'm initially bearish, right, and the overall trend is bullish, my best case scenario targets tends to be the equilibrium of the higher time frame quarter range, right? So that's initially what I'm always targeting for. But in this case, we had an obvious low right here. So this was a price-based liquidity, right? Meaning that price is what led to this range right here, right? So, but in the grand scheme of time, I would be utilizing just previous session or quarter highs and lows, right? So this trade was pretty much simple, very, very simple, right? But now, entries. How did I execute here? I did not use this fair value gap right here, right? That was not even what I was considering when I was entering the trade. But if you were utilizing this, it is still valid. What was I focused on was this right here. What is this? This was my breaker. And the reason why I trusted this as a breaker, right, is because if I can divide this range right here into quarters, I'm going to do it like this. And then you can just increase that and then make a copy of it like this, and then we can hide this just for a cleaner chart, right? If I drag this low like this, right, then I drag this one low like this. Okay, that's fine. Where did a breaker form? It formed within Q1, right? So when price drew back within Q4, I utilized the Q1 range to execute a trade within Q1, right? I just scaled in here as soon as I saw price tapping in within Q2, right? So that was just me scaling in, right? So this is initially how I trust breakers, right? They all have to be time-based, meaning that if my entry within the next cycle or the next quarter, right? If my entry is going to be high probability, it needs to be reacting based on the same time range, meaning that it needs to be reacting based on the same quarter range within a quarter, right? If I'm trading within Q2, I need to be using a period rate that's from Q2. If If I'm trading within Q3, it needs to be a PD array that is within Q3. If I'm trading within Q4, PD array within Q4, right? But if we have no PD arrays within this range and I want to scale in within this range right here, right? And I know this is probably not the best example with all these gaps, right? But it becomes very, very easy to see when you initially understand the logic, right? If I can drag this like this, right? I can use PD arrays within this range to get trades within this range. I can use this, for example, we have a inversion fair value gap. When price taps it or draws to it, I can execute a trade off it. Does it make sense? Here we're within Q3, right? I'm in Q4. Can utilize PD arrays within Q4 to get into Q4, right? We even got a volume imbalance just right there. Can you see that? So price creates this gap right here. Then within this range, within Q4, it draws back to it, taps and reacts off it, right? So that is simply the base level of how, right, I can trust a specific PD array, right? It needs to be reacting off the same range, right? Just a different quarter range. And then I use that in confluence with the whole higher time frame confluence model, right? Okay. This video is pretty short. There's really not much to say on it, but yeah, that's simply what I'm always looking for, right? Even when I'm trading the micro cycles, the micro sessions, right? But yeah, just had to do like a quick breakdown for everybody. And yeah, hopefully this video made sense. Hope you found some insights and enlightenment on it, right? But yeah, if you got any questions, just hit me up on the comment section or on Twitter. And yeah, I'll be happy to help you out. Okay.